Hello, brothers and sisters, and welcome back to Boss Economics World, the only channel that gives you the unfiltered truth behind the spreadsheet sophistry. Today is September 8, 2025, and the mainstream financial media is buzzing. The headlines are practically singing a lullaby, Fed to the rescue. A lifeline for Asia. The rate cut we've all been waiting for. They're quoting a very respectable gentleman, Albert Park, the chief economist at the Asian Development Bank. He says a potential U.S. interest rate cut would be welcome relief and beneficial for Asia. Beneficial. What a wonderfully sterile, economically approved word. It's like a doctor telling a patient with a festering gunshot wound, here's a Tylenol. This should be beneficial. Sure, it might take the edge off the fever for a few hours. But is it solving the problem? Or is it just a dose of cheap morphine to keep the patient quiet while the real disease metastasizes? Today, we're going to pull on that one thread, that one word, beneficial, and unravel the entire, tangled, and frankly terrifying tapestry of the global economy in late 2025. We're going to go from the point of a single rate cut to the surface of a systemic crisis. So buckle up. This isn't your grandfather's economics lesson. This is the real deal. Let's start with the point. The story is simple. The Federal Reserve, after a brutal hiking cycle through 2022 and 2023 and a long, anxious pause, is finally expected to cut rates. Why? Because the American economic engine is sputtering. The latest data is in, and it's not pretty. August's non-farm payrolls came in at a dismal 65,000, well below the 150,000 needed just to keep pace with population growth. The unemployment rate, which we were told was rock solid, just ticked up to 4.4%, the highest since the post-pandemic turmoil of 2021. The Fed, trapped by its own dual mandate, has to act. The inflation beast, while not slain, has been beaten back into its cage, and now the specter of recession is knocking on the door. So, they're preparing the monetary policy equivalent of a stimulus check, a 25 basis point mercy cut. And right on cue, the ADB's chief economist says this will be great for Asia. He points out that it gives a little bit of space on loan repayment. He's not wrong. But the sheer understatement is almost insulting. Let's zoom in on the two countries he specifically name-drops, Laos and the Maldives. These aren't just random examples, they are the canaries in the global debt coal mine. For years, they've been gorging on US dollar-denominated debt. Much of it came from grand infrastructure projects, like China's Belt and Road Initiative, which looked fantastic when global interest rates were near zero. But then, the Fed turned on the monetary fire hose in reverse. Between March 2022 and late 2023, they hiked rates from virtually zero to over 5%. For countries that have to pay back loans in dollars, this was a cataclysm. Every rate hike was an automatic tightening of the financial noose around their necks. The cost of servicing their debt skyrocketed. Let's put some hard numbers on this. Take a hypothetical $10 billion national debt, denominated in USD. In the zero-interest rate policy era, servicing this was manageable. But after the Fed's hiking cycle, the interest payments alone could have ballooned by hundreds of millions of dollars annually, money that could have been spent on schools, hospitals, or infrastructure. Instead, it was vacuumed out of their economies and sent to international creditors. So now, a 0.25% rate cut? Yes, it's beneficial. It's like your loan shark deciding to only break one of your kneecaps instead of two. You're grateful, I suppose, but you're still not walking tomorrow. This relief doesn't even begin to address the principle of the massive debt overhang. It's a rounding error in a ledger of sovereign despair. Now, let's zoom out from the point of the rate cut to the surface of the broader economic landscape. Mr. Park mentions that Asia's growth outlook is less certain because of the lagged effects of the impacts of tariffs. This is the polite, diplomatic way of saying that the economic war started by the Trump administration never really ended. It just became a permanent, grinding feature of the global economy. Let's look at the brutal data point the ADB itself provides. The average U.S. import levy on Asian goods is a staggering 27.8%. The global average is 18.6%. That's not a trade policy, it's a protectionist wall built with economic bricks. Mr. Park notes that the region has been surprisingly resilient. This is the single most dangerous and misleading narrative in finance today. What they call resilience, I call high-tolerance suffering. Let's break down what this resilience actually looks like on the ground. 1. The myth of the Great Supply Chain Migration. The theory was that high tariffs on China would cause a massive exodus of manufacturing to other Asian countries like Vietnam, Thailand, or Malaysia. Mr. Park himself inadvertently explains why this hasn't happened in a revolutionary way. He notes that since a lot of the countries got about the same rate, you don't see this big pressure to shift manufacturing. Think about it. If you're a multinational CEO, and the US is slapping a 25 to 30% tariff on your goods from China, moving your entire operation to Vietnam to face a 15 to 20% tariff isn't a brilliant strategic pivot. It's a marginally less terrible option. The cost, complexity, and risk of uprooting a decades-old supply chain are immense. So for many, the path of least resistance has been to stay put, absorb the cost, and pass as much of it as possible onto the American consumer. The stability of export markets he mentions is the stability of a hostage situation where everyone is too afraid to make a sudden move. 2. The squeeze on profit in people. So, who pays for these tariffs? The resilience is paid for by the squeezed profit margins of Asian manufacturers and the stagnant wages of their workers. A 2024 study by the Peterson Institute for International Economics found that in Southeast Asia's manufacturing sector, real wage growth has been nearly flat since 2022, despite rising inflation. To remain competitive under the tariff burden, companies have been forced to cut costs to the bone. That means less investment in new technology, suppressed wages, and precarious employment. The resilience is the sound of millions of workers running faster just to stay in the same place. 3. The currency wars. The other side of this resilience is a quiet, desperate battle fought by Asia's central banks. As the Fed hiked rates, the US dollar strengthened to multi-decade highs. To prevent their own currencies from collapsing, which would trigger import-led inflation and make dollar debt repayment impossible, central banks across Asia have been burning through their foreign exchange reserves. Japan, South Korea, and India have spent hundreds of billions of dollars propping up their currencies. This is a finite defense. It's like using your family's savings to pay for a fire hose to fight a volcano. It might work for a while, but it's not a sustainable solution. So, when you hear surprisingly resilient, don't picture a strong, flexible bamboo bending in the wind. Picture a boxer in the 12th round, taking body blow after body blow, still on his feet but barely conscious. That is the true state of Asian economic resilience. Now we get to the real heart of the matter. The rate cut and the tariffs are not two separate issues. They are symptoms of a much deeper, systemic disease, dollar hegemony. The entire global financial system is built on the US dollar. It's the world's primary reserve currency, the medium for most international trade, and the denomination for the majority of global debt. This gives the United States what former French President Valéry Giscard d'Estaing called an exorbitant privilege. It means the US Federal Reserve is not just America's central bank, it is, for all intents and purposes, the world's central bank, but one that only has a mandate to care about the US economy. This creates a terrifying doom loop for the rest of the world, especially emerging markets in Asia. Step 1. The US overheats. The US government engages in massive fiscal stimulus, pumping money into its economy. Step 2. The Fed reacts. To fight the resulting inflation, the Fed hikes interest rates aggressively. Step 3. Capital flees. Money from all over the world floods into the US to chase higher, safer yields. This causes the dollar to surge in value. Step 4. The world suffers. For every other country, this is a triple whammy. Their currencies plummet, importing inflation. The cost of servicing their dollar-denominated debt explodes. Their own central banks are forced to raise rates to defend their currencies, choking off their domestic economic growth. This is exactly what we saw from 2022 to 2024. The Fed's war on US inflation was fought with the economic health of Asia as collateral damage. The Sri Lankan default in 2022 wasn't an isolated incident, it was a preview. We saw Pakistan, Egypt, and Ghana all go to the IMF with a begging bowl. And now, in 2025, the loop is reversing, but not in a good way. Step 5. The US cools. The Fed's aggressive tightening finally works, and the US economy slows down, as we're seeing now. Step 6. The Fed cuts. To stave off a recession, the Fed begins to ease monetary policy. The ADB economist frames this as welcome relief. But what it really means is that the US is now exporting its economic weakness. A rate cut might weaken the dollar, offering net breathing space on debt. But why is the Fed cutting? Because they fear a US recession. And if the world's largest consumer market goes into a recession, what happens to the export-driven economies of Asia? Their biggest customer stops buying. This is the ultimate trap of dollar hegemony. When the US tightens, you suffer. When the US eases because it's heading for a recession, you suffer. It's a heads I win, tails you lose game, and the house always wins. The 25 basis point cut isn't a lifeline, it's a signal that the storm is about to change direction, but it's still the same storm. So, for those of you in the audience who are professionals, who manage money, what does this all mean? How do you play this? The initial market reaction to a Fed cut will likely be a euphoric, short-term risk-on rally. You'll see the MSCI Emerging Markets Index pop. Currencies like the Korean won and the Thai baht will strengthen against the dollar. It will feel like the good times are back. Do not be fooled. This is a sugar rush, not a recovery. The smart money needs to look past the headline and analyze the structural rot. 1. Differentiate. Mr. Park says other Asian economies are pragmatically managed with a sound outlook. This is a dangerous generalization. Pragmatically managed is often just a euphemism for has enough foreign reserves to postpone the crisis. You have to look country by country. The debt bombs, Laos, the Maldives, Pakistan, Sri Lanka. These are still no-go zones for any long-term investor. The debt-to-GDP ratios are astronomical, and their fiscal capacity is nil. A rate cut is a temporary patch on a sinking ship. The manufacturing middle, Vietnam, Thailand, Malaysia. these countries are caught in the crossfire. They benefit slightly from supply chain diversification but are also hit by the broad tariffs. Their growth is entirely dependent on global demand, which is now weakening. They are a bet on a global soft landing, which looks increasingly unlikely. The tech titans, South Korea and Taiwan. They are at the high end of the value chain, especially in semiconductors. But this makes them hypersensitive to the global economic cycle and the geopolitical chess match between the US and China. A US recession would crush demand for their most valuable exports. The domestic giants, India and Indonesia. These are perhaps the most interesting plays. With large domestic populations, they are less reliant on US consumption than their neighbors. However, they are not immune. India, for example, is still heavily reliant on energy imports, priced in dollars. A weak rupee can still import inflation and cause political instability. 2. Watch the real driver, the tariffs. The single most important variable for Asia's long-term health is not the Fed funds rate. It's the US-China relationship and the associated tariff regime. Until that structural conflict is resolved, any recovery in Asia will be built on sand. Investors should be watching trade negotiation rhetoric more closely than they watch Fed speeches. 3. The ultimate safe haven? Still the dollar. And here is the ultimate irony. In a world of turmoil created by US monetary and trade policy, the ultimate safe haven in a crisis remains the US dollar. If the US-led slowdown triggers a genuine global recession, you will see a flight to quality, and capital will flood back into US treasuries, strengthening the dollar all over again and restarting the doom loop. So let's go back to where we started. A beneficial rate cut offering welcome relief. It is a lie. A comforting, well-intentioned lie, perhaps, but a lie nonetheless. This isn't a benevolent doctor administering a cure. This is a drug dealer giving a desperate addict a slightly smaller, slightly cheaper hit. It will stop the shakes for a little while. It will provide a moment of artificial calm. But it does nothing to cure the underlying addiction, the world's addiction to US consumption and US dollars. The real problem isn't the interest rate. It's the tariffs that act as a permanent tax on global growth. It's the mountain of dollar-denominated debt that turns every Fed decision into a life-or-death event for developing nations. And it's the surprising resilience that is actually the slow, silent erosion of prosperity for hundreds of millions of people. So as you watch the markets rally on the news of a Fed pivot, I want you to remember this. Don't cheer for the painkiller. Ask why the patient is in so much pain in the first place. Because the system isn't broken, it's working exactly as it was designed for the benefit of the one holding the syringe. This is Boss Economics World. We don't just report the numbers. We read the code behind them. Stay sharp. Question everything. And I'll see you on the next one.